January 30th, 25. A single trading day that moved 1.8 billion ounces of silver, more than 2 years of global production, traded in just a few hours. Then something unprecedented happened. While paper prices collapsed by 40%, physical silver demand didn't just rise. It exploded at 250% of all-time records. One market crashed, the other couldn't keep up with buyers. The same asset, two opposite realities. Someone made billions, while others scrambled for what's real. The question isn't what happened, it's what they're not telling you about what happens next. Welcome to the boring currency. Now, before we dive into what really happened on that Friday, I need to ask you something. You know how your reading glasses are essential for seeing the fine print? Well, subscribing to this channel works the same way. It helps you see the fine print in global markets that others miss. So, if you value clarity over confusion, hit that subscribe button. It's right there, just like finding your glasses on your desk. And tell me, where in the world are you watching this from right now? London, New York, Singapore, Mumbai? Drop your city in the comments, because what I'm about to reveal affects every market everywhere. Now, let's talk about what they don't want you to know. January 30th, 2025 started like any other trading day. But by the closing bell, something had broken in the silver market, something that financial institutions had worked decades to keep hidden. The numbers told a story that defied logic. Paper silver prices plummeted 40% in a matter of hours. Yet across the physical market, a completely different reality was unfolding. SD Bullion, one of America's largest precious metals dealers, reported something they had never seen before. Their transaction volume exploded to 2.5 times their previous all-time record. That previous record, it happened during the Silicon Valley bank collapse in 2023, a moment of genuine financial panic. But Friday's numbers made that look small. The revenue they generated in a single day exceeded what they had made in entire months during 2025. One day outperforming 30. Think about that for a moment. While the price was supposedly crashing, demand was exploding, the same asset moving in two opposite directions simultaneously. This wasn't just unusual, it was impossible under normal market conditions. On the COMEX exchange, where silver futures are traded, the numbers became even more disturbing. 1.8 billion ounces of silver changed hands that Friday. To understand how absurd this number is, consider this. Global silver mines produce approximately 800 million ounces per year. That's the entire world digging, processing, refining for 12 months. On Friday, traders moved more than double that amount in just a few hours. More than 2 years of global production traded before lunch. But here's where the story gets darker. By the end of the trading day, most of those contracts had been closed. They weren't buying silver to hold it. They weren't taking delivery of physical metal. They opened massive positions, drove the price down, then exited. The silver itself, it never moved. It was all paper, digits on screens, contracts without substance. This is what analysts call a synthetic market, a market where the volume of trading has no connection to the actual physical asset. For business leaders and strategic thinkers, this matters deeply because it reveals how modern commodity markets actually function. The price you see on financial news is not determined by physical supply and demand. It's determined by whoever controls the largest paper positions. And on January 30th, someone with enormous capital decided to move that price downward. Violently, meanwhile, in the real world, where actual silver bars and coins exist, a completely different story was playing out. Dealers across North America and Europe began rationing silver. Some implemented purchase limits per customer. Others raised premiums, the extra cost above spot price to historic levels. Sovereign mints, the government-backed institutions that produce official coins, started falling behind. New orders that used to ship in 2 to 3 weeks now delayed to 8 to 10 weeks. Production timelines quadrupling in just 30 days. This is the classic signature of a supply crisis. When demand overwhelms available inventory, delivery times extend, premiums rise, rationing begins, yet the official price, the one flashing on every financial terminal, kept falling. For experienced market observers, this divergence sent a clear signal. The paper market and the physical market had decoupled. They were no longer moving together. And when that happens in commodity markets, history shows what comes next is rarely calm. The strategic question for business leaders becomes obvious. If you hold a paper contract that says you own silver, but physical silver is unavailable for delivery, what exactly do you own? A promise, a derivative, exposure to a price, but not the asset itself. This distinction between owning the thing versus owning a claim on the thing is fundamental to understanding modern markets. And on January 30th, that distinction became impossible to ignore. The professionals who understand market structure, the ones managing Syria's capital, they saw something else in these numbers. They saw a stress test, a moment when the system's vulnerabilities became visible. Because if this can happen in silver, a relatively small market, what happens when the same dynamics appear in larger markets? What happens when the paper claims far exceed the physical assets into gold, oil, or sovereign debt? Friday's silver crash wasn't just about one commodity. It was a warning shot, a glimpse into how modern financial architecture really works, and more importantly, how it breaks. What happened on January 30th wasn't an accident. It was executed with surgical precision, and the evidence is hiding in plain sight. Most people see a price chart, a red candle, and think the market moved. But sophisticated analysts see something else entirely. They see fingerprints. Let's examine how this operation actually worked. On a normal trading day, the COMEX silver market operates within predictable parameters. Trading volume typically runs between 100 to 120% of open interest. Open interest is the total number of active contracts that haven't been closed or delivered. So if there are 1 million contracts open, you might see 1.2 million contracts traded. This is normal market activity, buyers and sellers exchanging positions. But Friday, the numbers shattered every historical pattern. Trading volume hit 345% of open interest, nearly 3.5 times the normal ratio. This wasn't trading, this was something else. Imagine a small town with 10,000 houses. On a normal day, maybe 10 to 12 houses change owners. Now imagine 35 houses trading hands multiple times in a single afternoon, the same properties flipping back and forth at lower prices each time. That's not a real estate market. That's market manipulation. And that's exactly what the data shows happened in silver. Here's how the mechanism works. Large institutional traders with access to enormous leverage open massive short positions. A short position is a bet that prices will fall, but when the positions are large enough, they don't just bet on falling prices. They create falling prices. The flood of sell orders overwhelms the market, driving prices down. Other traders, seeing the plunge, panic and sell their positions too. This accelerates the decline, creating a cascade effect. Then within hours, the same institutions that open these positions close them. They buy back the contracts at the lower prices they just created. The profit, the difference between where they sold and where they bought back, multiplied across hundreds of millions of ounces. The profits are staggering. But here's the critical detail that exposes the operation. Almost none of these trades involved actual silver delivery. If this were genuine selling pressure from investors liquidating physical holdings, you would see delivery notices spike. You would see warehouse stocks at COMEX increase dramatically. You would see physical silver flooding into the market. Instead, the opposite happened. Warehouse stocks barely moved. Delivery intentions remained minimal. The physical silver market tightened further. This tells experienced observers everything they need to know. The selling wasn't real. It was synthetic. Paper contracts created solely to manipulate the price, then dissolved once the job was done. Now, why does this matter to business strategists? Because this same structure exists across multiple asset classes, commodities, currencies, bonds, equities. Anywhere derivatives trading volume exceeds the underlying physical asset, this vulnerability exists. The lesson isn't just about silver. The lesson is about understanding how modern markets are controlled. Consider the broader implications. If a small group of wealthy capitalized institutions can move prices this dramatically in a commodity market, what prevents them from doing the same in other markets? The answer, very little. Regulatory frameworks were designed for a different era. When trading volume had some connection to physical assets, when markets were constrained by actual supply and demand, but derivatives changed everything. They created the ability to generate unlimited paper claims on finite physical resources, and whoever controls the largest paper positions controls the price. This is why veteran market participants distinguish between price and value. Price is what appears on the screen determined by whoever has the most leverage in the derivatives market. Value is what someone will actually pay for the physical asset when delivery is required. On January 30th, these two concepts diverged spectacularly. The paper price said silver was worth 40% less, but the physical market, where real transactions occur, said the opposite. Premiums soared, availability vanished, delivery times exploded. These are the characteristics of an asset becoming more valuable, not less. So, which signal should sophisticated investors trust? The paper price created by institutions trading contracts they never intend to fulfill, or the physical market where real buyers and sellers exchange actual assets? History provides the answer. Every time this divergence has appeared in commodity markets, the physical market eventually wins. Paper claims can be printed infinitely, but physical assets, they remain constrained by geology, mining capacity, and production timelines. And when the gap between paper claims and physical availability becomes too large, the system corrects violently. What happened on Friday wasn't the end of this story. It was the beginning. The institutions that executed this operation achieved their short-term objective. They generated profits. They shook out weak hands. They maintained control. But they also revealed something they probably didn't intend. They showed everyone paying attention exactly how the game is played. And more importantly, they exposed just how fragile the paper system has become because it now requires increasingly extreme interventions to maintain the illusion. The question for strategic thinkers isn't whether this system is sustainable. It clearly isn't. The question is what happens when it breaks. While traders were playing games with paper contracts, something unexpected was happening in the physical world. The real economy was rejecting the artificial price, and the evidence was appearing everywhere, if you knew where to look. Sovereign mints are the backbone of the physical precious metals market. These are government-backed institutions. The United States Mint, the Royal Canadian Mint, the Perth Mint in Australia. They produce the official coins that investors trust. American silver eagles, Canadian maple leafs, Australian kangaroos. These aren't just collectibles. They're strategic assets for serious wealth preservation. And in late January, something unprecedented started happening at these institutions. Their production schedules collapsed under demand. Just 30 days earlier, if you ordered silver coins from a major mint, delivery took 2 to 3 weeks. Standard industrial timeline, nothing unusual. By early February, that timeline had exploded to 8 to 10 weeks. Some mints were quoting 12 weeks for certain products. Think about what this means. These are industrial operations running multiple shifts with established supply chains. They don't quadruple their delivery times because of minor fluctuations. This happens when demand overwhelms their entire production capacity, when orders are coming in faster than they can possibly manufacture product. And remember, this is happening while the official price of silver supposedly crashed 40%. In normal market logic, when prices fall, demand should decrease. Lower prices mean less urgency to buy. But the opposite was occurring. The lower the paper price went, the more aggressively people bought physical metal. This inverse relationship revealed something profound. Informed buyers weren't looking at the COMEX price as information. They were looking at it as an opportunity, a temporary distortion created by paper manipulation, a chance to acquire real assets at artificially suppressed prices across the dealer network. Similar patterns emerged. Major bullion retailers implemented rationing systems. Some kept purchases at 500 ounces per customer per day. Others raised their premiums, the markup above spot price, to levels not seen since 2020. During the peak of pandemic uncertainty, premiums on silver rounds hit $4 to $5 over spot. By early February 2025, some dealers were charging $6 to $8 over spot. On a metal trading at roughly $30 per ounce, that's a 20 to 25% premium. In normal markets, premiums stay below 10%. When they spike above 15%, it signals severe supply stress. At 25%, the physical market is screaming that something is fundamentally broken. But the story gets even more interesting when you examine the geographic distribution. This wasn't just American buyers panicking. Reports came from dealers in Germany, Singapore, Dubai, Australia. The physical silver market is global, and the buying pressure was appearing everywhere simultaneously. This suggests institutional awareness, not retail panic. Sophisticated buyers, family offices, wealth managers, corporations with treasury operations, these entities don't move on emotion. They move on analysis. And their analysis was telling them the same thing. The paper price had disconnected from physical reality. And in that disconnect, opportunity existed. Now consider the production side of this equation. Global silver mine production runs approximately 800 million ounces annually. That's not a number that can change quickly. But you can't just make more silver because demand increased. Mining, Snort's operations take years to develop, require massive capital investment, face geological constraints. Even if every silver mine on Earth ran at maximum capacity, they couldn't significantly increase output in less than 18 to 24 months. So when demand suddenly spikes, as it did in late January, there's no supply response possible. The only variables that can adjust are price and delivery time, and both were adjusting dramatically, except the official price was moving in the wrong direction. This created a bizarre situation. The COMEX screen showed silver getting cheaper, but actually acquiring physical silver was becoming more expensive and more difficult. Two realities existing simultaneously in the same market. For business leaders trained in supply chain management, this pattern is immediately recognizable. It's the signature of a system under extreme stress. When delivery times extend, when rationing appears, when premiums explode, these are not signs of a market with abundant supply and weak demand. These are signs of shortage. Yet the price signal, the one most people trust, was saying the opposite. This divergence creates a strategic question. In a world where paper derivatives can be created infinitely, but physical assets remain constrained by production capacity, which market tells the truth? The answer became obvious to anyone actually trying to buy silver. You couldn't get it at any price close to the COMEX quote. The paper market said $30. But the real market, where actual transactions occur, was pricing it at $37 to $38 after premiums. And even at those prices, You had to wait 2 to 3 months for delivery. This is how paper manipulation eventually fails. You can suppress the price on a screen, but you cannot manufacture physical metal out of thin air. And when enough buyers demand the real thing, the fiction collapses. History is filled with examples of this dynamic. In the 1970s, gold's paper price was suppressed through the London gold pool until the physical demand became so overwhelming that the system broke. And gold went from $35 to $850 in less than a decade. The same pattern appeared in palladium in the early 2000s. Paper price suppression followed by a physical shortage, followed by explosive price discovery. And now the evidence suggests silver is entering that same trajectory. The January 30th crash wasn't the end of the story. It was the catalyst that exposed how fragile the paper system had become, because the physical market didn't just resist the paper price, it completely rejected it. The events of January 30th were not isolated. They were a symptom of something far larger, a fundamental instability built into the architecture of modern finance and business leaders who understand this position themselves very differently than those who don't. Let's start with the uncomfortable truth. What happened in silver is happening across multiple asset classes. The ratio of paper claims to physical assets has reached historically unprecedented levels. In gold, analysts estimate there are somewhere between 100 to 250 paper claims for every physical ounce. In oil, futures trading volume dwarfs actual production by factors of 30 to 50. In sovereign bonds, the derivatives market exceeds the underlying debt by multiples most people cannot comprehend. This isn't a conspiracy theory. These are documented market statistics available to anyone willing to examine exchange data and regulatory filings. The system works until it doesn't. And January 30th showed us what doesn't work looks like. For strategic thinkers, the implications extend far beyond precious metals. This is about understanding counterparty risk. When you hold a financial instrument, a contract, a derivative, a promise, you don't own an asset, you own a claim on an asset. And claims are only as good as the institution backing them. In stable times, this distinction seems academic, but in stress, it becomes everything. The business leaders who survived 2008 learned this lesson. Those holding mortgage-backed securities thought they owned diversified real estate exposure until they discovered they actually owned complex derivatives backed by deteriorating loans. The paper said one thing, reality was completely different. Silver's divergence is teaching the same lesson again, but there's a deeper strategic insight here. Markets are information systems. They're supposed to aggregate knowledge, reflect supply and demand, guide capital allocation. But when derivatives trading volume exceeds the underlying asset by factors of hundreds, the information signal breaks down. Price no longer reflects reality. It reflects whoever controls the largest leveraged positions. This creates profound strategic vulnerabilities. Corporations making long-term capital, allocation decisions based on commodity prices, pension funds building portfolios based on bond yields, manufacturers hedging input costs in futures markets. All of these decisions assume the price signal is accurate. But what if it isn't? What if the price is artificially maintained until suddenly it isn't? The businesses that recognize this and position accordingly gain enormous strategic advantage. They stop asking what is the price and start asking what is the real supply and demand dynamic. These are different questions with different answers. In silver's case, the answer is clear. Annual production, 800 million ounces. Industrial demand alone, approximately 600 million ounces. Solar panels, electronics, medical applications, water purification. These industrial uses are not price sensitive in the short term. A solar panel manufacturer doesn't stop production because silver rises $2. The silver content is a small fraction of total panel cost. Add investment demand, jewelry, coinage, and you have structural deficit, less produced than consumed year after year. Yet the price, until recently, has been suppressed for over a decade. How is this possible? Only through massive paper market intervention, creating the illusion of unlimited supply through derivative contracts. But illusions cannot sustain themselves indefinitely. Eventually, physical reality asserts itself. And when it does, the repricing is violent. We're beginning to see the early stages of that repricing now. The widening premiums, the delivery delays, the rationing. These are not temporary disruptions. They're structural symptoms of a market reaching its breaking point. For business leaders, this presents both risk and opportunity. The risk is obvious. Any operation dependent on silver or any commodity facing similar dynamics faces potential supply disruptions and price volatility. But the opportunity is more subtle. Understanding market structure, recognizing paper versus physical divergence, seeing through price manipulation, and these skills apply across all markets. They allow strategic positioning ahead of major dislocations. They enable capital preservation when others are caught unaware. Consider the broader economic context. We live in an era of unprecedented monetary expansion. Central banks have created more currency in the past 15 years than in all previous history combined. Yet commodity prices, real assets, have been suppressed through derivative markets. This creates a dangerous imbalance. Infinite claims on finite resources. At some point, the claims must adjust, or the resources must reprick. There is no third option. January 30th was a stress test of the system, and the system revealed its fragility. The institutions that orchestrated the paper price crash achieved their tactical objective, but they also showed their hand. They demonstrated that maintaining price suppression now requires increasingly extreme interventions, and each intervention creates larger distortions in the physical market. The gap between paper and physical, between claim and asset, between price and value, that gap is widening. And gaps of this nature, historically close, suddenly, not gradually, suddenly, the strategic question for business leaders is simple. When the gap closes, where do you want to be positioned? Holding paper promises that may not be fulfilled, or holding tangible assets with intrinsic value. This isn't about fear. It's about understanding probabilities. The probability that paper claims exceeding physical assets by 100.1 ratios remain stable is low. The probability that physical assets retain value when paper systems face stress is high. Risk management isn't about predicting the future. It's about positioning for multiple scenarios and ensuring that in the worst scenario, you survive. In the best scenario, you prosper. What happened on January 30th wasn't the crisis. It was the warning, a glimpse into how quickly orderly markets can become disorderly, how paper confidence can evaporate, how physical assets become unavailable at any price. The institutions managing serious capital, sovereign wealth funds, family offices, central banks, they understand this, which is why their behavior, their actual asset allocation, often contradicts their public statements. They speak about digital assets and modern portfolio theory while quietly accumulating physical gold, strategic commodities, real assets. This divergence between words and actions tells the real story. The silver market's dysfunction is a mirror reflecting the instabilities embedded throughout the financial system. And for those paying attention, it's providing a clear signal. The time to prepare for structural change is before the change occurs, not after. Because once the paper system breaks, once the gap between claim and asset closes violently, there will be no time to reposition. No opportunity to convert paper into physical. The window closes suddenly, just as it did on January 30th. When paper plummeted and physical became unavailable, the question isn't whether this pattern will repeat. The question is, when it does, will you be